Hello everyone, and today we are going to discuss our new chapter on capital structure. Before formally discussing this chapter, let's have a look at our mind mapping. If you look at this mind mapping, we know that there are two major decisions that a company makes: financing decisions and investment decisions. Financing decisions are the decisions where the companies they get the funds from debt and equity and use them in the investment decisions. Okay, and when a company makes investment decisions, then the companies they generate cash flows. So financing decisions are generation of funds and investment decisions are uses of funds. Okay, and we know that the value of the firm is equal to cash flow divided by WACC. So cash flows they are generated through investment decisions. Okay, and the weighted average cost of capital it is created through these financing decision. Okay, so we can see that the value of a firm is affected by the cash flows, in other words investment decisions, as well as it is affected by WACC as indicated by financing decision. Okay, we knew in our last chapter when we say WACC, in WACC we have debt, weight of debt, and its cost of debt plus weight of equity, cost of equity, and all that. Okay, so it means the combinations of equity and debt, or in other words the financing decision through debt and equity affects the weighted average cost of capital, which in turn affect the value of the firm. So value of a firm is affected from investment as well as financing decision. Okay, now in this chapter we will see that the value of the firm is affected by financing decision. We have already looked at this investment part in our previous chapter. Our focus would be more on cost component. Okay, since this weighted average cost of capital has an inverse relationship with the value of the firm, so it means if WACC changes, value changes. So what are the components that affect the WACC? So they are actually financing decisions. So when in a financing decision we say the changes in financing decision it means the changes in debt and change in equity. These changes will affect the WACC, and then this change in WACC will affect the value of the firm. Okay, so if I define this chapter, we can say that whether the changes in financing decision of a firm affect the value of a firm. Okay, so this is the theme of the chapter. Now this is a further mind map of that definition, that changes in the capital structure, or in other words financing mix changes the value of the firm. Changes the value of the firm mean which part of the value of the firm will be affected. It means it will decrease or increase the cost component. Okay, so changes in capital structure or financing mix changes the value of the firm. So that is a question. So there are different theories that explain this relationship. Some theories say that there is no effect of capital structure on the value of the firm. Some theories says that no, there is a relationship between the capital mix or capital structure on the value of the firm. Okay, so that's why we divide our theories into two parts. Number one, relevance theory, and the other one is irrelevance theory. So the irrelevance theory says that we then divide relevance and irrelevance into two parts. Relevance and irrelevance theory. When we say irrelevance, it means then there are no market imperfections. It means there are no taxes, no transactions costs, no nothing. So this theory, irrelevance theory, is proposed by Miller and Modigliani. It says that without taxes, the value of the firm is not affected by any combination of capital structure. So changes in capital structure has no effect on the value of the firm according to them. Okay, so then we divide this irrelevance theorem into two parts, proposition 1 and proposition 2. Proposition 1 um, always talks about that the value of the firm with debt is equal to value of the firm without debt. So any combination mean when a company has debt, its value is equivalent to a situation when the company has no debt. Okay, and in the proposition 2 we look at the cost of equity component is equal to when the company has no debt, when the company has debt to equity, no debt minus cost of debt. Okay, so we will discuss these things, these parts in detail in our chapter, but first you need to remember that in irrelevance theory there are two propositions, proposition 1 and 2. Proposition 1 always talks about the value and proposition 2 always talks about cost of equity. Okay, next we will move to relevance theory. And when we say relevance, it means there are taxes, okay, or market imperfections. First market imperfection is taxes. Okay, so then again we divide our proposition into two parts. Proposition 1 will talk about the value like in proposition in the first part. Okay, so it says that the value of the firm, levered firm, is equal to value of unlevered firm plus present value of interest tax shield. And proposition 2 will also talk about cost of equity, but it will also adjust this tax component. So the only difference between MM theory without taxes and with taxes is the tax component. Then there are some other theories that are also says that the capital structure is relevant for the value of the firm, are trade-off theory and pecking order theory. So we will also look at these theories in detail. Since we have already taken the mind map of our today's lecture, so this is the outline. So first of all we will define what is capital structure, and then we will see what is Modigliani proposition 1 and 2. 1 and 2 without taxes, first of all it means irrelevance, and then we will include market imperfections, and the first imperfection would be tax. Okay, so when we include tax, then we will discuss proposition 2 with taxes, so it will give us relevance theorem of So this is called 1963 theorem, and that is called 1958 theorem. Okay, then again we will combine some other market imperfections like bankruptcy and financial distress. When we include them, then we get trade-off theory. Okay, so this is again a relevance theory. Then we have a pecking order theory, which is also relevance, and then we will see some additional consequences of leverage mean debt. So that is an additional topic. Okay, so basically there are major two market without market imperfection, irrelevance theory. When we add imperfection number 1, we get relevance 1963 theory. So when we add some other market imperfections, we get trade-off theory and pecking order theory. And then lastly we will see additional consequences of leverage. So let's first define what is capital structure. Capital structure is the mix of debt and equity. So debt to equity combination like 50% debt, 50% equity, 30-70, 40-60. So any combination of debt and equity is called capital structure. Okay, so debt to value ratio is the fraction of firm's total value that corresponds to total debt. So it is called debt to value ratio, means debt to capital ratio. How much is the debt in the total mix? So it means it shows weight of debt. Okay, a higher fraction of debt indicates a higher degree of financial leverage. So when we say a financial leverage, it means debt has the higher component. So when we increase our debt components, for instance 50% debt, uh, 30% leverage decreases, then leverage increases, let's say if it is 10%, 90%, so we can say that financial leverage decreases. Okay, so the fraction of debt in fraction of this debt components is called as financial leverage. The optimal capital structure, means the optimal combination of debt and equity, is the one that reduces this overall cost of capital. Okay, so when this overall cost of capital will decrease, the value of the firm will increase. So in other words, a capital structure is considered as an optimal that has that gives us lowest cost of capital and highest value of the firm. Okay, because this part is targeted by, this part basically comes from investment, and this part comes from this combination. Okay, now let's look at proposition 1, and it is an 1958 theorem, and it is given by Miller and Modigliani, and the name of the paper was The Cost of Capital, Corporate Finance and Theory of Investment. So the proposition 1 says that in a perfect capital market, the total value of a firm is equal to market value of free cash flows generated by its asset and is not affected by its choice of capital structure. So it means this definition says that the value of a firm in a perfect capital market means that there are no taxes, no transaction costs, no market imperfections. Okay, value of the firm is affected by the change in cash flows generated by assets. Assets mean real assets. So it means the value of the firm is affected by only investment decision, not the financing decision, because WACC will remain, this WACC will remain constant at any combination of capital structure. So any combination of capital structure will give us a constant WACC. Okay, so that's why the value of the firm is not affected by capital mix or capital structure, because WACC remains constant. The only factor that increases the value of the firm is cash flow generated by its real assets. Okay, so as you can see, value of the levered firm mean when the company has a debt is equal to equity plus debt is equal to value of unlevered. So in other words, even when there is no debt, the value of the firm is equal to equity. When there is no debt, this value of the firm is called value of unlevered firm. Okay, so when we add debt, we will call it as value of levered firm because we added some debt. So value of levered firm is equal to value of unlevered firm when there are no taxes. Okay, so what are the implications for this proposition? It says that when the value, let's say we will write two values. Okay, there is no debt in, there is debt in this value, so we will call it as value of levered. So there is zero debt in this one, we will call it as unlevered. So even a company has debt, and when the company has no debt, then their value should be same one. Please remember one thing, that when we say okay, so when we say value of levered firm is equal to value of unlevered firm, we are talking about the same firm. Okay, so we are not calling two different firms. Okay, so it means this company A, when it has debt, it will be value of unlevered, and its decision not to take the debt, value of unlevered, same firm. So we are not comparing actually two firms, we are comparing two policies of financing. When take dividend, debt, it will become levered, and when it has no debt, it will become unlevered. So we are comparing the two policies of the same company. Okay, don't get confused, we are not comparing two firms. Okay, So company is same, A, value of levered A, value of unlevered A. Okay. So implications are a firm cost capital structure is irrelevant. So we just saw that the value of the firm has no, so capital structure has no effect on the value of the firm. A firm's weighted average cost of capital is the same no matter what mixture of debt and equity is used to finance the firm. So any combination of debt and equity has no effect on weighted average cost of capital, so that's why the value does not change. So this is graphically shown here. So any combination, when there is no debt, okay, WACC remains, this is the WACC, okay, and this WACC will be equal to RE because we have cost of equity. When there is no debt, the only cost will be equity, okay. So when we keep on increasing the debt, what will happen? WACC remains constant, so it is not changing. So we know that we have an inverse relationship between value and WACC. So when WACC remains constant, the value does not change, okay. So we can replace this WACC with V, and we can say that the value also does not change with any combination of debt and equity. So we call it as capital structure, okay. Any combination of debt and equity has no effect on value of the firm, or value of the firm or capital structure is irrelevant for the value of the firm, okay. So this is proposition number 1. Okay, when we say that there are no taxes, or in other words a perfect capital market, what does it mean? It means that the securities are fairly priced. All the securities, bonds and stocks, they are traded at a competitive price. It means that there are no taxes, and market decides the prices, okay. So it means there are no taxes, no transaction costs. That is why securities are traded at a fair value. There is no mispricing. And then there are no consequences or transaction costs, no tax consequences or transaction cost. So this is again a second market imperfection. If you buy or sell stocks, you don't need to pay any transaction cost, you don't need to pay any tax. So that is again a feature of perfect capital market. And also the investment cash flows are independent of financing choices. So it says that financing decision and investment decisions are not dependent on each other. They are totally independent decision. When you are making investment decision, you are not thinking about the financing decision. So when you are financing something, you are not thinking about investment decision. It means both of them are independent decisions. So you need to remember 3 features of perfect capital market. Securities are fairly traded, no transaction cost, financing and investment decisions are independent. Okay, this is again the graphical depiction of proposition 1. Same form, okay. So capital structure 1, capital structure 2, capital structure 3. Okay, so same form, but it has a capital structure decision 1, decision 2 and decision 3. So this is a situation when company is 100% equity finance, so we will call it as this is value of unlevered firm. So in this graph, the company in this picture, the company did not take any debt, so this is capital structure 1. Then company took some debt, so that is called capital structure 2. Then again company took some more debt, so that is called capital structure 3 of the same company, okay. So 3 different capital structures are compared, and the result would be, so any capital structure would be irrelevant. All the capital structure would be irrelevant for the value of the firm. In other words, value of capital structure 1, value of the firm when the capital structure is 1, value is equal to value of the firm when the capital structure is equal to 2, value of the firm when the capital structure is equal to is 3, okay. So it means the value will remain same. at any combination of debt and equity. Now let's take a question for proposition 1. You are considering opening a coffee shop that is expected to generate free cash flow of 34,500 in 1 year. So remember one thing, when we say the value of firm has a perpetual life. Okay, so that's why we say V is equal to CF divided by WACC. But here in this question they are saying cash flows of 34,500 in 1 year. So it means they are specifying some number of years. So that's why we will do 1 plus WACC power 1. Okay, otherwise we use this formula for valuation of the firm. Okay, so in this question we will do 1 plus WACC, but please remember here the number of years are mentioned, but if there are no mentioning of number of years, we will be doing only WACC, because companies they have perpetual life. Okay, so I'm writing it like this. In 1 year 34,500 would be the cash flow. The initial investment required for this project is 24,000, so that is 24,000 CF0. Cost of capital is 15%, interest risk-free interest rate is 5%. First of all, what is the NPV of this project? That's very simple. We need to discount it back and we need to find NPV. So let's see what is the answer. Okay, in the first part we saw that this is CFO and this is present value of cash inflows. NPV is positive, so we should accept this project. Let's get to part B. Assume that the three conditions identified by apply and you consider raising money solely by selling equity in the business to your friends and families. How much money can be raised in this way? That is, what is the initial market value of the unlevered equity? Okay, so it means the question is asking us that the company wishes to take all of the money through equity. Okay, so when it means the value will become unlevered. So the question is asking us to find the value of the firm when there is 100% equity, and the conditions are three conditions of apply, mean market is perfect. So let's find our value of the firm. So value of the firm, we know that is equal to CF divided by WACC. Since we have 1 year, so we will do 1 plus WACC. Okay, so let's calculate the value of the firm is equal to value of the firm, mean V is equal to CF divided by 1 plus WACC. Okay, so that's why this formula is written here, 1 plus WACC. Since it's all equity firm, that's why we are writing VU. So the answer is 30,000. Okay, so value of the firm is 30,000. So in other words, we can also write for the proposition 1, it's equal to value of levered is equal to debt plus is equal to value of unlevered. Okay, so in other words, VL is equal to equity plus debt, okay, which is equal to value of unlevered. Okay, so value of unlevered, we just got 34,500 divided by 1.15, so that is 30,000. In this question we don't have any debt, so value is equal to equity. Okay, whatever the value we got, 30,000 is the value of market value of equity, or in other words value of equity. Okay, because there is no debt, so all of the value that we are getting is equity. Okay, then we will see part C. Suppose the initial 15,000 is instead raised by borrowing at the risk-free interest rate. What is the initial market value of the levered equity, and what are the cash flows paid to equity holders in 1 year according to Okay, remember one thing, there is a difference between unlevered equity and levered equity. So when we say value of the firm is, we only have debt plus equity. Okay, so let's say in this situation there are two situations, is equal to debt plus equity. In the first case there is no debt. Okay, so we will call it as value of unlevered equity. Okay, in first case we calculated unlevered equity, which is equal. Okay, in the second case, this equity, the company has debt, but we will call this equity as value of levered equity. Okay, so it means equity in a company when there is debt. So in part 1 we calculated equity. Okay, in part 2 we are calculating unlevered equity. In part C we are calculating value of levered equity. Okay, for this question, according to MM1, the total value of the firm should not depend on its capital structure. Okay, so value of the levered firm is equal to equity plus debt. Equity means levered equity is equal to value of unlevered firm is equal to 30,000. We just got that value of the firm, this value of unlevered is also equal to levered, so that's why we are using this one here. Okay, so 30,000, the initial market value of the levered equity will be, equity is equal to 30,000 is the total value of the firm minus debt, it's equal to 15,000. So equity is 15,000, debt is also 15,000, but remember this equity is a levered equity. Okay, so it means you need to remember these three steps. First of all, we will calculate the value of the firm. We always calculate the value of the firm through cash flow divided by WACC. Once we get the value of the firm, we will then see VL is equal to equity plus debt is equal to VU. Okay, okay, so just remember this formula. Okay, we will use this value here. Okay, if the company has no debt, so it will be VU is equal to equity, but if the company has debt, like in our case, this will be VL equity plus debt. Okay, then from this formula, then you will calculate equity is equal to VL minus D. We will get value of levered equity. Okay, so that's why in our first case we calculated value of unlevered firm. Unlevered firm was the answer 30,000. In the second case, we again calculated VL. So again it was 30,000. Okay, we use 30,000 here and we use 15,000 in this D and then calculated equity. Okay, now in the next part, question says what are the cash flows that are paid to equity holders in 1 year according to So how much is the, in 1 year 34,500 will be paid to both equity holder and debt holder. Okay, so 5% is the if the debt holders you finance at 15,000, so after 1 year you will pay 15,750. 5% is the risk-free rate. Remaining will be the cash flows paid to the equity holder. Okay, 34,500 minus 15,750. This cash flow will be distributed to equity holders. Okay, now this figure again, unlevered versus levered cash flows with perfect capital market. So these assets, they generate cash flows of 34,500, and since it's an unlevered, how much will it go to equity holders? All of this money will go to equity holders because this company has no debt, so all of them who will receive? Equity holders will receive all of these cash flows. So if we discount this value, we will get 30,000. So value of equity is equal to 30,000. Okay, so investor receive in first case total 34,500, but if we discount it back, so this is equal to 30,000. Okay, in next case, firm has 34,500 same cash flows. Okay, so same cash flows, it will be distributed 15,750 to debt holders, okay, and remaining to equity holders. So equity holder receive 18,750, 15,750, same thing, but the value will remain same, that is 30,000. Okay. Okay, just I'm repeating this part again. So let's say situation 1, company has no debt, we know that, and this is true for this company, 34,000 in 1 year. So what is the value of the company? So value of the company is equal to CF divided by 1 plus WACC. Since I know that there is no debt, so I can write VU. Okay, so VU is equal to CF divided by 1 plus WACC is equal to 34,500 and all this answer. Okay, so once I get this answer, then I will use these details to calculate equity, because in this part in the first part I calculated the value, in the second part I will calculate equity. So how can I get the equity? We know that the value of levered firm is equal to value of unlevered plus value of debt plus equity is equal to value of unlevered. Since there is no debt, 0, so I can remove this and equity is here. So value of unlevered is equal to equity. So the value of equity in the first part is 30,000. Okay, so let's repeat this part for the second part. Okay, for in the second situation we have debt is equal to 15,000, WACC is 15%. So now we know that there is a capital of debt in this capital structure, so we will calculate the value of the firm. In this case I will write VL is equal to CF divided by WACC. So this is the answer. So once I got this answer, that is 30,000, I can now get the value of equity. So how do I write? VL is equal to D plus E. This is proposition 1. Okay, so I am interested to get the value of equity, and this equity is called levered equity. So whatever is the answer will be the answer for your levered equity. In this case, unlevered equity was 30,000. In our first case, this one, and in this case we have 15,000. Okay, now as can we see, if the equity holders, because in this structure we just got that the value of equity is equal to 15,000. okay, so 15,000 is the value of equity. So if the investors, in the company we have 15,000 equity, so equity holders will receive how much in future? 18,750. okay, so this is the cash flow that they will get after 1 year, and debt holders, they will, with 15,000 they will get 15,750 extra. Okay, so let's calculate cost of levered equity. Cost of levered equity mean when we have a debt, 15,000 is the equity, initial equity that the investors they have invested. So after 1 year they will get how much? 18,750. So what is the difference? We need to calculate R is equal to, we will apply this formula, future value is equal to PV 1 plus R power N, and from this formula we will get R. Okay, so the answer will be 25%. So this 25% is the value of cost of equity when we have leverage. Okay, so this same cost of equity we can calculate with the formula of proposition 2, and remember that the cost increased from 15% to 25%. okay, so when we increase debt, Initial cost was 15% and now it changed to 25%. So proposition 2 can also help us to get this 25%. Here is a formula for that. Cost of equity, levered equity. When there is this part is missing, so it will be cost of unlevered equity. So cost of levered equity is equal to cost of unlevered equity plus debt to equity, cost of unlevered minus cost of debt. Okay, so we can get the same 25% when we will apply proposition 2. Okay, so cost of levered equity equals the cost of unlevered plus the premium proportional to the debt to equity ratio. If we increase the debt to equity ratio, this part will increase, so cost of equity will also increase. So if you see, RE is equal to RU. RU mean when there was no debt, 15% was the cost of unlevered equity plus debt is 15%, 15,000, equity is also 15,000. So RU is 15%, RD is 5%, so answer is 25%. Okay, so RE, cost of levered equity, when we include debt, increases. Okay, so this is proposition 2. So let me summarize this. Proposition 1 and 2, without taxes, VL is equal to VU, or in other words, debt plus equity is equal to VU. Proposition 2 always talks about RE, this part. Okay, RU plus debt to equity, RU minus RD. Okay, so from here, from once we get the how do we get the value is equal to CF divided by WACC. Once we get the value, we can get equity because debt is already given, so you don't need any extra formula to get the debt. So that debt is easy to find. Okay, that was proposition 1 without taxes. Now what are the proposition 2 implications? Two implications mean RE implications. Okay, proposition 1 and proposition 2. What are the implication of proposition 2? We need to see. First of all, we know that the firm value is independent of capital structure because WACC remains constant. I already discussed you any combination of debt and equity. At any combination of debt and equity, WACC remains constant. Okay, so WACC of unlevered is equal to WACC of levered. However, how is that the firm weighted average cost of capital stays the same even after adding leverage? Okay, so why is that case so that no leverage and with leverage, why it remains constant? It is because when you add debt, RE increases, but there is a benefit that RD is always lower. Okay, so higher increase in cost of equity is actually matched with a decrease in cost of debt. So the debt is cheap, equity is expensive, so they actually balance each other. So that's why the WACC remains constant. Okay, as you can see, because the creditors have a claim to income and assets that has preference over equity, the cost of debt will be less than the cost of equity. So debt is always cheaper than equity. The use of additional debt or financial leverage appears to be cheaper for firm, but its cost of equity increases. So cost of equity increases, but this is cheaper, so that's why they cancel each other's effect and WACC remains constant. As such, the overall WACC remains constant and hence firm value remains constant. Okay, next question is, leverage increases the risk of equity even when there is no risk that the firm will default, and the question is why? Risk of equity always means that the equity holders will not get the return. Okay, so it means even there is no default risk, since the equity debt holders, they receive the money first and then leftover is received by equity holders. So that's why when there is a debt, these equity holders think that debt holders will receive the funds first, after that they will claim. So, and we don't know actually how much would be the claim, whether they will be giving some profit or not. So that's why their risk always increases when there is debt, because the debt holders, they receive the first claim. So this is the graphical explanation of WACC and leverage. As you can see, when we increase the leverage, first of all, WACC remains constant. Okay, so this is proposition 2. Okay, and this is not proposition 2, this is proposition 2. Okay, this is the implication that the WACC remains constant. Cost of debt is constant at certain rate, but after a certain limit it also starts increasing. Okay, and cost of equity, it will start increasing when there is no debt. So this is the cost of equity in our question, 15%. But when we start increasing the debt to equity, our cost of equity starts increasing. Okay, so from proposition 1, value does not change, but cost of equity increases because debt increases the risk. Now there are some benefits of debt as well as its cost. Okay, so market imperfections such as taxes, bankruptcy, information asymmetry, etc. suggest that the capital structure can be important. Okay, and we need to understand the benefits and cost of using debt. In the previous cases, we have already considered value of the firm when there are no market imperfections. Now we have started adding market imperfections. Okay, so first of all, we will, before discussing the market imperfection, we need to see what are the benefits and cost of using the debt. Number one, when we have a debt, we can get interest tax shield. I will explain this later. It means, okay, let me explain that. So for instance, we have EBIT of 100 and interest of 20, you get EBT, that is 80. Okay, case number 1. Case number 2, same form, 100, no debt, 0, so it will be 100. Then we pay tax by 50%. Here the tax is 40, and in B case the tax would be 50. The answer will be, earning after tax is 40. The answer here will be 50. Okay, as you can see, in our first case we are just paying a tax of 40, while we are paying a tax of 50 in our B case. So in first case we are getting some benefit of taxes because there is some interest payment that we have reduced. So with when we have a debt, we pay less taxes. So that's why the debt provides some interest tax shield, and also the debt is less expensive to issue equity than equity. Okay, so as we have seen that debt is normally the cheaper one than the equity. Why? Because the equity holders, they claim their returns first. After that, debt holders, they will receive their claims first, and at the end equity holders will get their claims. Okay, disciplinary mechanism force manager to do the right things to generate sufficient cash flows to service debt. It means that when we have a debt, banks, they normally force the manager to do the right things, because they are called the disciplinary mechanism on the companies. If there are no debts, managers, they can manipulate the company's funds on their own discretion. Okay, but if there are some debts, the debt providers, they monitor the managers. Okay, so it means with the increase of debt, there is increased monitoring on the company as well. That is good. Cost of using debt, so there is some possibility of financial distress, and also there is agency cost between debt holders and shareholders, which manifest more clearly in the situation of financial distress. So actually, when the company is filing bankruptcy, then this conflict actually manifests more, and debt holders, they will claim all these assets first, and then residual will be left for the shareholders. Okay, so agency cost becomes more visible when there is bankruptcy filing. So as we know that when we include debt, we can get some tax benefits. Okay, so higher debt means higher tax benefits. So this is reflected in this picture, that the value of the firm is equal to equity, 100% equity, all equity. So that is value of the firm is equal to value of equity. Okay, so then we added some debt but more equity, then value of the firm 2 is equal to value of equity plus value of debt. Okay, and then we have more debt than equity, then the value of the firm 3 is equal to value of equity 3 plus value of debt 3. But what is the takeaway from this picture is that when we increase the value of debt, the value of the company should increase. Okay, so this value should be higher than this value than this value. So in other words, capital structure 1 will give us lower value of the firm, capital structure 2 will give lower value of firm than when we have capital structure 3. So it means when we increase debt, value of the firm increases because of the tax benefit. Okay, now in our proposition 2, in relevance theories, we will include taxes. Okay, so now we have started our relevance theories. Previously we were discussing irrelevance theory and we discussed some benefits of debt so that we can include our tax component. Okay, so relevance theory, again we have first of all Miller-Modigliani proposition, proposition 1 and proposition 2. Okay, so proposition 1 always talks about the value. So the value of the levered firm is equal to value of unlevered plus present value of interest tax shield. So it means value of levered is equal to equity plus debt plus present value of interest tax shield. Okay, so we can find the value of the firm, or in other words, value of levered is equal to value of unlevered plus present value of interest tax shield. So how to calculate this interest tax shield? First of all, in the second part, interest tax shield is equal to interest rate multiplied by tax rate multiplied by interest payment. So how do you get the interest payment? That is equal to debt multiplied by cost of debt. Okay, so that is interest payment, and then we calculate the present value. So that is why they have written present value of interest tax shield. Okay, so yeah, and now interest tax shield with permanent debt mean for the perpetual bond the formula will be T into D. So how do we get this part? When we have permanent debt, that is just T into you need to multiply debt with the tax component. Okay, so let's see how do we get this formula. Interest tax shield is always equal to interest payment multiplied by tax rate, and we know that this interest tax payment is equal to debt into cost of debt. So interest tax shield should be equal to, we can substitute this information, D into KD into TC. So what is the present value of interest tax shield when it is permanent? When we say permanent, it means we cannot write 1 plus KD. Okay, we will just write KD. Okay, so D into KD into TC divided by KD. So the answer would be D into TC. Okay, and we know that for what is the formula for the perpetual debt, that is equal to interest divided by cost of debt. Okay, so this is the present value of perpetual debt, but we are more interested in the present value of interest tax shield. So interest and tax, and then we need to calculate the present value, so we divided by KD. Okay, so if you are confused with this one, you don't need to understand this. Okay, because the price of the perpetual bond is equal to interest divided by RD. Okay, so this is a perpetual bond, but if we have some number of years, we do 1 plus RD power n. Okay, since it's a permanent debt, we can write it like that. Okay, so this formula is actually used. So so price is equal to present price. Price is always equal to present value. Okay, so it is interest RD into debt divided by RD. So that is T only, and when we say tax shield, we will just multiply it with tax component. Okay, so present value of interest tax shield is equal to D into TC, if you want to understand this further. Okay, so this is proposition 1 with taxes. Now let's calculate proposition. Okay, now let's do the proposition 1 implications. Implication says that debt financing is highly advantageous, and in the extreme, the firm's optimal capital structure is 100%. So it means if we increase the debt, we can increase the value of the firm. A firm weighted average cost of capital decreases as the firm relies more heavily on debt financing. So with the increase in debt, the WACC should decrease. Okay, so the WACC, when the WACC decreases, actually the value of the firm also increases. So weighted average cost of capital in the presence of taxes should be cost of equity, weight of equity. Okay, equity is equal to equity divided by total capital employed plus weight of debt, cost of debt, 1 minus tax. So that is again the same thing, RE, weight of equity plus weight of debt, cost of debt, 1 minus tax. Okay, so this is actually the WACC. So if we adjust this formula again, this formula, so we can separate the reduced tax benefit. Okay, so if you arrange this part of the formula mathematically, you get all of this part. Okay, so both these formulas are same, but in the second part they have just separated the interest tax shield reduction part. Okay, so to capture the effect of interest tax deduction on the firm value, you can either okay, because we have a tax benefit, we can, while calculating the value of the firm, these two points says that effect of interest tax deduction on the firm value, you can either do discounting free cash flow using the pre-tax WACC and adding the PV of the future interest tax shield. In other words, while calculating the value of the firm, you can calculate the pre-tax WACC and then can add present value of interest tax shield. Or in other words, you can use the value of the firm by you can calculate the value of the firm by calculating after tax WACC. Okay, so they should both give the same answer. Okay, this slide actually focuses on excuse me, this part of this formula, how to calculate interest tax shield and then present value of interest tax shield. Okay, that's a very simple slide. So interest expenses are given. Interest tax expenses for EC builders are as below. Given its marginal corporate tax rate of 35%, what is the amount of the interest tax shield for ECB in 2010 through 2013? Okay, so these are interest expenses given and tax rate is 35%. We need to calculate the after tax interest. We need to adjust actually the tax benefit on this interest expense. It means we need to find the interest tax shield. Simply multiply 50% with 35%. Okay, the remaining will be 17.5. okay, after tax. So if you see, interest tax shield is, so before taxes you are paying 35, but because of the debt you took some benefit and you saved 17.5. on this 80, When the debt increases and you are paying the interest expense of 80, you are saving more. So when that is increasing and you are paying 100, you are again saving more. So higher the level of debt means higher the interest expense. So higher the interest expense means higher tax benefits. Okay, so when the debt increases, interest tax shield, interest expense, they also increase. So when the interest expense they also increase, interest tax shield also, it also increases. Okay, so it means higher level of debt increases the higher interest payment, which ultimately increase the tax benefits. So that was a very simple slide where we need to calculate the uh, interest tax shield. So if you add all of these interest tax shield, so how much saving did you do? You saved 115.5 million with just tax savings. Okay. Next, there is a problem where we need to value the interest tax shield. Suppose ECB borrows 2 billion by issuing 10 years bond. ECB's cost of debt is 6%, so it will need to pay 120 million in interest each year for the next 10 years. Okay, and then repay the principal of 2 billion in year 10. So we know that this formula of the bond. How much is the payments? 120 for how many years? For 10 years. Okay, ECB's marginal tax rate will remain 35% throughout this period. By how much does this interest tax shield increase the value of ECB? So we need to find the present value of interest tax shield. Okay, so the interest tax shield each year is tax rate multiplied by interest payment. Okay, so that's equal to 42 million. So that is interest tax shield. So PV is equal to every year C is interest tax shield multiplied by, divided by R D 1 minus 1 over 1 plus RD power N. And here you are not writing any maturity value because the maturity value does not add any tax advantage. Okay, so we will just use interest tax shield only. Okay, so 42 million 1.06, and this is the answer 309 million. Okay, so it means with this debt of 2 billion, the company um, can increase the value of the company by 309 million through interest tax shield. Okay, so the value of the company in this formula will be increased by how much? 309 million. Okay, that was a very simple case. Now proposition 2 with taxes. Previously we did proposition 2 without taxes, and this part was missing. But now when we have with taxes, we will do 1 minus tax. Okay, so when we increase debt, the cost of equity will also increase. Okay, but this increase is relatively lower than when there was no tax benefit in our previous case. Okay, so RE, cost of levered equity, is equal to unlevered plus debt to equity, unlevered minus cost of debt, 1 minus tax benefit. Okay, so again, if you see, we can divide the relevance theory into two parts, proposition 1 and proposition 2. They are very simple. Value of levered is equal to unlevered plus present value of interest tax shield, and what are the implications? WACC decreases, RE increases. WACC decreases, why? Because of the tax benefit coming from the debt. And why RE increases? Because of the financial distress cost. Okay, I will explain it later. So RE is equal to RU plus D over E, RU minus RD, 1 minus tax. So these are the two major propositions that you need to remember from 1963 theory. Previously it was 1958 theory. Okay, now we have covered already the tax as a market imperfection. Now we will be incorporating bankruptcy and financial distress. Okay, if increasing debt increases the value of the firm, why not shift to 100% debt? So that is a genuine question. If we increase the debt, we know that the value of the firm will increase, but then why not taking 100% debt? It is because as the firm increases the borrowing, the risk of financial distress increases. So it means the company may go bankrupt. Okay, so in other words, the financial distress increases. In other words, chances of bankruptcy increases. Financial distress occur when the firm has difficulty making payments to creditors. Okay, in other words, bankruptcy. Cost of financial distress are costs arising from bankruptcy or distorted business decision before bankruptcy. So it means adding the debt will give you tax benefit but will also lead to bankruptcy, or in other words, financial distress cost. So tax is a benefit, distress is a cost. So it means debt has both benefit as well as cost. Benefit in the form of tax shield, cost in the form of financial distress. Okay, cost reduces the value of the firm, debt benefit increases the value of the firm. Okay, direct bankruptcy cost, the legal bankruptcy cost, it includes the bankruptcy such as legal and administrative expenses. So these are the direct bankruptcy costs. And what are the indirect bankruptcy costs? First of all, they are difficult to measure, and we can see that we lose our customers, we lose our suppliers, employees, and or from fire, sales of assets, or sometimes we actually sell our assets to pay to creditors. Okay, so these are two basic costs for the bankruptcy, that is direct bankruptcy cost and indirect bankruptcy cost. Okay, so what is the takeaway from this slide? This slide is actually leading us to add another component in the value of the firm, that is financial distress, when you add debt. Okay, so it will give us a trade-off theory. So trade-off theory says we need to add the financial distress with the taxes as market imperfection. Okay, 1963 added just tax, and trade-off theory will add, when we add financial distress, it will become trade-off theory. Okay, so the trade-off theory says the total value of the levered firm equals the value of the unlevered plus present value of interest tax shield. This is proposition, but when we subtract cost, it will become trade-off theory. So value of the firm is equal to unlevered plus benefits minus cost. Okay, so the optimal capital structure is the one where benefits are equal to cost. Okay, so we need to actually match these cost and benefits. So that was trade-off theory, and this is graphical depiction of the trade-off theory. So it means when we increase our level of debt, the value of the firm should increase. Okay, and this is called MM1 with taxes. Okay, and this is present value of interest tax shield. But trade-off theory says at a certain level of debt, the cost, it starts increasing. So when the cost starts increasing, the value should decrease. Okay, so it means before this level of debt, the cost was not significant. When we increase more debt, it will generate more financial distress cost. So when the financial distress cost increases, the value should decrease. So this graph, this shows the trade-off theory graph. Okay, and this is MM1. Okay, so as you can see, from here to here is present value of interest tax shield benefit. Okay, and this is financial distress. Okay, so when we increase the debt after a certain limit, financial distress cost starts coming and it becomes significant and it decreases the value of the firm. So what are the implications of the trade-off theory? Trade-off theory actually helps us to resolve two important facts about leverage or about debt. The presence of financial distress, because in the trade-off theory we have financial distress, we have incorporated financial distress. Cost can explain why a firm chooses debt levels that are too low to exploit the interest tax shield. Okay, so it means if there are no financial distress cost, firm will choose more debt. Since we have financial distress cost, that's why the firm they do not use higher level of debt and they reduce their debt level. And then differences in the magnitude of financial distress cost and the volatility of cash flows can explain the differences in the use of leverage across industries. Okay, so it means that certain industries have a higher financial distress than the other one, and also some companies have more volatility of cash flows. So different the financial distress and the cash flow volatilities, they determine the level of leverage to use. Okay, so it means the financial distress is the main determinant of use of debt when we have certain volatility of cash flows. As when we know the industrial volatilities of cash flows, then financial distress is a good determinant to know how much leverage should we use. Next is different firms have different targeted capital structure. Profitable firms with safe tangible assets should have used higher debt ratios. The companies with higher fixed assets, they should use more debts, okay, because they can be used as collateral. Unprofitable firm with risky intangible asset should have lower debt ratio. Okay, it actually leads this point actually leads to this point, and this point leads to this point. Sorry, not this point, this is a different point. Okay, so it means those companies that are not profitable, it means they have higher volatility of cash flows, they should actually use a lower level of debt, because financial distress in such companies will be higher. Okay, in reality many profitable firms do not have much debt. Why? It is because most of the profitable firms, they can retain their earnings, they can use their retained earnings to finance their investment, so they might use lower level of debt. And also debt is usually financed to finance the to make an investment. So when a company is profitable and maybe he has not much growth potential, so that's why it's of no use to use more debt, because it has very low or very less investment opportunities. Okay, the next is pecking order theory. Pecking order theory is that managers have preference to fund investment using retained earnings, followed by debt, and will only choose to issue equity as last resort. So it means when the company does the financing, company will use its internally generated fund first, retained earnings, then it will use debt because it is less costly, and then it will use equity. Okay, so that's why it's called pecking order. So based on um, so that is actually called pecking order. There is a reason behind this pecking order. Number one, manager's information about the firm and its future is likely to be superior to that of outsider. So managers sitting in this company, they have superior information than people outside. So people outside, they will require more return from the company because they have little information about the company. So when the gap increases between the outsider and the company, the cost of capital increases, and it is true when it is equity. The debt holders, they can get some private information from the company, so compared to equity, debt is less expensive. But retained earning is the source of fund where there is zero information asymmetry because they are under the control of the company, so it should be cheaper. Okay, so higher the information asymmetry, higher would be the cost of financing. So that's why the companies, they choose least costly source of fund, that is retained earning. Okay, because information asymmetry is less, and then they will choose debt and then equity. Equity is the last resort because equity offers higher information asymmetry. Okay, the announcement of stock issue drives down the stock price because investors believe managers are more likely to issue when shares are overpriced. I think it should be actually underpriced. No, this is true. Okay, so companies they generate issue they issue stocks in the market. When companies they issue equity when the company thinks that the stocks are overpriced. Okay, so when they are overpriced, it means these investors they are requiring low return. Okay, so in that case company will issue more equity. Therefore, firm prefers internal funds since funds can be raised without sending adverse signals. So it means there is no market information is asymmetry. If external fund finance is required, firms issue debt first and then equity as a last resort. Okay, so what is the main takeaway from this pecking order theory is information is asymmetry is the major determinant for the cost of capital, and equity has the higher information asymmetry. Okay, so that's why it will be issued as a last resort, and if funds needed, the company will go for retained earnings first. If more funds are needed, the company will go for debt, and equity will be the last resort. So pecking order theory implication, because equity is the least is the expensive one. So according to pecking order hypothesis, firms should almost never use equity financing. Okay, so high profitable firms will have little debt in their capital structure. Okay, because we just saw that from the previous slides that profitable firms they have little debt in their capital structure because they have little to invest and they will be using more of their retained earnings. Okay, when firms are profitable and generate sufficient cash to fund their investment, they will not issue debt or equity but just rely on retained earnings. So this is the first point. Profitable firms they have more retained earnings, so they can use that. Only firms that need to raise external capital will have a significant debt financing. Okay, but in case if the company needs more funds and our retained earnings are not sufficient, then companies will have uh, debt financing as their main source of financing. So okay, if you learn about this information that firms with high ratio of fixed assets have higher debt ratio. So if the companies have high fixed assets, mean more tangible assets, then you can imagine that the company will be going for higher debt, and this is what trade-off theory says. But when a company is more profitable, then the company will use lower debt ratios. So that is what pecking order theory says, because here retained earnings will be used more. So there is no single optimal capital structure theory. In practice, observed capital structure can be explained by a combination of theories. So actually there is no single universal capital structure theory. Okay, so it depends that what is the situation of a company, and company can use mix of or combination of different theories. Both the trade-off theory and pecking order theory offer some insight into how managers choose the capital structure for their companies, but neither is also explained all of the capital structure choice that we observe. Okay, so it means any capital structure cannot determine the 100% behavior of other companies. So every company has their own set of capital structure given its circumstances. Now we are looking at the additional consequences of debt. Okay, so first of all is the agency cost. Agency cost is a cost that arises when there are conflicts of interest between managers and equity holders. Okay, so there is a conflict between these two, between agents and principal. Okay, so when there is a debt in a company, let's see what is the situation then. Okay, so when there is no debt, number one, when there is no debt, these managers they can use the funds of these principals anywhere they want. Okay, so there is no monitoring. But if there is debt in this company, what will happen? Okay, shareholder manager agency cost. It occurs as a result of separation of ownership and control. So this is we know, in which managers make decisions that benefit themselves. Okay, these managers sitting in this company will make decisions that are not in the best interest of shareholders. Okay, if these decisions have negative NPV for the firm, they are a form of agency cost. So they will actually, the managers, they would like to uh, when there is no debt, these managers, they will invest funds in negative NPV projects. Why would they do that? Because if they are the manager of bigger company, their salary compensation will also increase. So they are doing that to increase their compensation, but not for the interest of the shareholders. So that is called an agency cost. But let's see if there is a debt. Debt provides incentive for managers to run the firm efficiently. Why? Because ownership remain more concentrated, improving monitoring of management. So debt holders, when the debt providers they give debt to this company, then they can provide the monitoring as well. The banks or the lending institutions, they have more monitoring of the company. So higher the monitoring of the company will reduce the agency cost. Okay, so debt is normally used as a source to reduce our agency cost. Okay, so it means the managers now cannot misuse the funds of the shareholder. Okay, okay, these two slides, this slide as well as this slide, I can explain that through this graph, because this graph has explained beautifully the implication of debt for the agency cost. Okay, so let's say we know that the value, when we increase the debt, the value of the firm should increase, and this is proposition 1 1963. Okay, so this is the case. So when we increase the value of the debt, then we know that the financial distress will come in and the value of the firm will decrease. So that was trade-off theory, we know that. Okay, but if the, so this is the optimal level of debt. So before that, this debt, the picture is green, and after that it's kind of orange or yellow. Okay, so if you see too little leverage, when there is lower level of debt, what happens? We can we can forgo the tax benefits. Okay, and the managers, they can enjoy the excessive works because there is little monitoring. So managers, they can use their shareholders fund, and they can do wasteful investment, and they can create their own they will invest for the empire building, and they will invest the funds of the shareholders for empire building. Okay, so it means agency cost will be very high. But if we have too much of debt, uh, there will be high monitoring. Okay, financial distress cost, of course, will increase. There is excessive risk taking, and then there is some underinvestment. Here there is over investment because the managers, they can use the funds of shareholders, but here there will be higher monitoring. Okay, interest rate will also be higher, though you will take some tax benefit, but there are also some higher financial distress cost. Okay, so excessive risk taking, and then there is some under investment issue, and also there is lower monitoring cost as well. Okay, because the bank or the lenders, they will take care of they will provide extra monitoring on the managers. Okay, so these are some benefits when there are too little leverage and too much leverage. There are some benefits and costs that we need to remember. But this is the optimal level of leverage. So this is the level of leverage that the company should use, at which you are actually comparing your benefits with the cost. Okay, so what is the takeaway of the implication of debt for the leverage? So it's for the agency cost. It says that debt Number one, it reduces the agency problem. It disciplines the managers, and managers, they cannot use they cannot follow the negative investment projects. So when the managers, they cannot follow the negative investment project, it means they are more disciplined. Okay. Okay, now let's solve a question. The Alpha Construction Company is levered firm with a current total value of 100 million. So it's a levered firm, so we can write VL. Okay, it's equal to 100 million, comprising of 80 million equity. So this is levered equity and 20 million permanent debt capital. Okay, the company is planning to borrow an additional 20 million of debt capital and use the money to buy back 20 million of its equity. Okay, so company wants to issue more debt so that it can buy back its shares. The cost of capital of the cost of equity of Alpha Construction Company before the share buyback is 10%, and the pre-tax cost of debt is 6%. The corporate tax rate is 30%. Okay, so first of all, we need to find, based on the information provided, calculate the value of Alpha Construction Company's unlevered equity. So we know that value of levered is equal to value of unlevered plus present value of interest tax sheet. So in this question, this is already given, and this is also given. We need to find value of unlevered firm, because this is exactly equal to unlevered equity. Okay, so we need to find this. So currently this is the situation, 100 million. Value of levered firm, unlevered, we need to find because it is equal to equity. So interest tax shield, 20 million is the debt initially. Okay, and then tax rate is 30%. So if we arrange the formula, that 94 million would be the value of unlevered, or this is also equal to unlevered equity. Okay, so company's unlevered equity. First part is done. Then we see the second part. Now the company wants to take for 20 billion extra debt. So what will be the value of the Alpha Construction Company after the share buyback? Okay, so we need to find value of the company after share buyback. Okay, so that is equal to VL is equal to VU plus present value of interest tax shield. Now the debt increased from 20 million to 40 million. Okay, so rest and value of unlevered already we got it, that is 94 million. So what is the answer? 106 million. So company's value increased from 100 million to 106 million when the company took an extra debt of 20 million. Next part says calculate the Alpha Construction Company's cost of capital after the share buyback. So after the share buyback, we need to find the cost of equity. So this is the formula for the cost of equity. RE, RU, D over E, RU minus RD, 1 minus tax. But in this question, RU was not given, so we need to find RU first. So for RU, this RE is given. So this is cost of equity before the share buyback. Okay, so this is 0.1. RU, we can find it. Previously, we had 20 million debt, 80 million equity, and then we need to arrange all this formula to get RU, that is equal to 9.40%. Okay, so now we know that our value increased from 100 to 106. So value of levered is equal to value of unlevered, is equal to debt plus equity. Okay, so that's equal to 106. Debt is how much? 40 million plus equity. If I ask you what is the value of levered equity, so it will become 106 minus 40, so that is 66. Okay, so the new value of equity is 66. So previously it was how much? 94. Okay, because we bought the equity now, so the value of equity will decrease from 94 to 66. So equity is 66 and debt is now 40. So we need to find cost of equity now. So RE we already got it from here. Debt is how much? 40. Equity is 66. and 9.4 minus 6, 1 minus tax, so answer is 10.84%. Okay, so after the share buyback, what is the situation? Your cost of equity has increased from 9.402, sorry, from 10% to 10.84%. Okay, next, that's a very simple part. We need to find the WACC, weighted average cost of capital, after the share buyback. So RE, the new RE, okay, equity is 66, and this is the total new value of the firm, and RD is 6%, and 1 minus tax, it will give us 70%. Debt is a new debt, that is 40%, and this is the new value of the firm. So if you calculate the WACC, your answer would be 8.33%. So that was a very simple case of calculating the WACC. So lastly, this is the mind map again. So we discussed the capital structure and we divided the theories into two parts, irrelevance as well as relevance theory. Irrelevance theory says that there are no taxes, no market imperfection. So we get 1958 theory, proposition 1 and 2. Proposition 1 says value of unlevered is equal to value of unlevered. Okay, so at any given level of debt and equity, value remains constant and also the WACC remains constant. And the proposition 2, we talk about cost of equity. So cost of equity increases with any given level of with increasing level of debt and equity. Okay, for the relevance, we divided it into four parts. Number 1, with taxes we got proposition 1961, proposition 1 and 2. Okay, proposition 1 is value of levered is equal to unlevered plus present value of interest tax shield, and the value increases when we increase the level of debt. Why? Because the WACC decreases. Okay, and also the cost of equity increases. In both cases, proposition 2, 1958 and 61. So both are increases. Okay, next we had financial distress. When we include the financial distress, this is present value of financial distress, we get trade-off theory. Okay, and trade-off theory says that the optimal capital structure is the one where the benefits coming from the tax are equal to the cost arising from the financial distress. And then we talked about information asymmetry, and it gave us pecking order theory. So when there is information asymmetry actually generates higher cost of financing. So equity becomes more risky because it has high information asymmetry than debt and retained earnings. So company will prefer retained earning. And then agency cost, so debt actually reduces the agency cost and it disciplines the managers. Okay, but higher level of debt, though it increases the agency, it reduces the agency cost, but it will cause an underinvestment issue. Underinvestment issue is when there is higher monitoring by the banks. Managers, they cannot even pursue the positive NPV projects. Okay, so because they will do all the projects based on what the bank says, not what they actually think. Okay, so it also generates some agency cost. So when it means when the company is planning to do the capital structure, to make a capital structure decision, agency cost is one of the factors that they actually account for. Okay, so that is all for today's lecture. Thank you so much.